The biggest shift that has happened over the past few years is there was a huge price increase in 2020 and 2021. There's a lot of complacency coming out of COVID still lingering because the courts were closed. I'm a senior director and the head of industry research at AM Best. That would create a severe impact if there are claims that are latent, dormant, not settled.
Hello, my name is Jason Reichl, and you're listening to Risk Management Brick by Brick. I'm fascinated with people who are helping build and maintain the physical world around us. On each episode of this podcast, we'll dive in with a risk manager, speak to them about how technology plays a role in this process.
Thank you for joining me for Brick by Brick, Riskworld 2025. We've been doing this for 3 days, and I am excited to talk to you particularly about D&O markets and what's happening there. But for the audience at home, why don't we give a little introduction?
Hi, my name is Sridhar Manyem, and thank you so much for having me.
Yeah.
It's a pleasure to join you on your podcast. I'm a senior director and the head of industry research at AM Best. And what that entails is we are the thought leadership arm of AM Best.
Yeah.
So we try to provide unique insights about the industry, topical events, and of course, rating implications. So for all the topics that happen. And for those people who might not be familiar, our company is called AM Best. It's a credit rating agency. It's the world's oldest credit rating agency that is really focused on insurance. We're the only insurance company that's global and is focused only on insurance.
Yes.
We've been doing this for 126 years.
Everybody in our audience is aware of AM Best. You guys drive a lot of innovation in the space. You guys have a lot of interesting things. I was listening to your panel yesterday and thought some of the interesting questions that would be good for us to cover is you've been analyzing the D&O market for years, right? I can track your work back. But what's the biggest shift you've seen recently and what's driving it? And if you're still in the exploring phase of that, that's fine too.
No, that's fine. I think for people who may not be familiar with D&O insurance, it's one of the most important cogs in the puzzle of the corporate world.
Yes.
What that does is it provides protection to directors and officers who serve on the boards of public and private corporations.
Yes.
And also senior management, so that when they are providing oversight, if there's any negligence or something happens, their personal assets are protected, where they don't have to dip into their personal assets when they are getting sued, or when the company's share price drops and the shareholders are angry and they sue the company and there's a regulatory investigation, for example, for improper disclosures and things like that. So that's the essence of D&O. There are many sides to it. There's a side A that protects the personal assets of the directors and officers, especially when the company is not able to pay them, because when the company is bankrupt and directors and officers are sued, then the bankruptcy acts might say the company cannot pay the directors and officers first because other creditors and other stakeholders are going to be in line. So when the company is unwilling or unable to pay the directors and officers, the side A cover protects their personal assets. And side B and side C are pretty similar, but they are for essentially corporations. When they get sued as a person, then the side B and side C cover kicks in either for reimbursement of directors and officers or for the company itself. So various fascinating line of business. And business, I mean, if you really trace back, the momentum for this industry really came from Enron, the whole scandal, the accounting failures that happened in this accounting firm called Arthur Andersen. All those incidents kind of drove the momentum for the D&O market. And of course, it's a very volatile line because the severity is huge. If you look at
the impact is always major.
Exactly. Yeah. So you're absolutely right. The impact, I mean, that word is, very crucial, because you look at the Enron crisis, you look at the 2001 technology boom and the bust, look at the subprime crisis of 2008, and even more recently, the banking collapse, the Silicon Valley Bank and regional banks that collapse. All those create high severity issues for these D&O insurers, and the legal costs are also increasing. So it's a fascinating line. And I think the biggest shift that we've seen is
There was a market paying attention to it. Companies need.
yeah, I think the biggest shift that has happened over the past few years is there was a huge price increase in 2020 and 2021 because companies were really paying attention to the hashtag Me Too movement and claims coming out of that. There was a lot of severity out there, and the influx of securities class action lawsuits really increased. And obviously the prices also increased because the companies were really risk averse. But I think what the main issue I'm watching is the industry becoming too complacent, and they're decreasing prices really steeply these days. Over the last 12 quarters, we've seen pretty steep price declines.
Yeah.
We're not sure if that's those price declines are a reflection of true risk or just the market.
My next question on this was, is it a pricing pressure that's decreasing risk? Because I noticed that too. Litigation trends, or is this just not that big, happens as often? So the risk profiles for these companies selling this insurance, they can lower the premiums.
Exactly. I think that's the kind of complacency that sets in, right? I mean, what you said about, I think you hit the nail on the head, because there's something called a regulatory cycle. When the regulations become too rigid and the enforcement actions start taking place, and the companies get into trouble. And then after some time, the regulations start becoming a little bit lax and companies become complacent, and the underwriting cycle also shifts, right?
Yeah,
so I think that's what's happening out here. But I do think there's a lot of complacency coming out of COVID still lingering because the courts were closed. There was a lot of backlogs in the courts, and I think they're just starting to move through the system.
So you think these policies are about to be a lot more executed?
Exactly. Yeah. These are claims-made policies, right? Which means you write the policy, there's a retroactive date, which means the companies can, if something happens till the retroactive date, the companies can file for a claim. And there is also something called the extended reporting period. So till that extended reporting period, the companies can file a claim. So you're not, just because the year is done.
Right. It's time and place of incident, right?
Yeah,
Driven by
absolutely. Yeah. So when the year is done, you cannot really close your books and say, we're done with this policy. You have to wait for the extended reporting period. And if the suit is filed, the legal system has its own time frame to execute, right?
Yeah, I think you're hitting it. I was going to ask about the troubles ahead for D&O, but I think we understand. I think it's going to be put to the test. Popularized, bought, kind of neglected, maneuvered, and now the courts are going to be picking this stuff back up. We're going to see that coverage in action.
Exactly. Yeah, that's a possibility. And that's what we are cautious about. So if you look at the actual profitability of the industry, the loss ratios are really good for the insurance industry. It's like in the 40s or something. And the companies are really making money in terms of the calendar year loss ratios. And my main worry, and AM Best's main worry, is that calendar year loss ratio a reflection of future ongoing profitability, or do the companies have to take action because of these emerging issues?
Let's say the insurance industry got it wrong on these in the ways that they wrote the policies. What could be the impact to the actual industry?
That would create a severe impact if there are claims that are latent, dormant, not settled, and then they come into fruition and they result in large settlements.
Because then the people get more litigious about it?
Yeah. We are worried about a couple of trends out there. One is litigation funding.
Okay.
So these are firms that actually take money from investors.
Right.
It could either be the public stock investors or it could be private investors. And they use this money to really go after firms. So they are actually, this is money looking for suits to file and settlements to happen so that they can return that money to the investors. So that is a big trend that we are worried about. And the other worry is also social inflation. In general, jurors and citizens are becoming increasingly skeptical of corporations.
Yes.
And you look at punitive damages, right? So, I mean, there's two parts to a settlement. One is indemnification. So if a car hits a passenger, then there's a indemnification. You pay for the car and the associated damages. And then there's the punitive settlement, which is you want to send a message to the world, this kind of incident cannot happen again. So in order to do that, you do something called a punitive damages. And that is really exacerbated because of...
Yeah, and it's an unknown factor. You can say, hey, the asset got damaged, and you can put that into a policy and bind that. But then what's this extra damage that's going to be put out through the court process that we have zero idea about?
Yeah, how do you price for that?
Yeah, exactly. Well, I mean, I guess traditionally you would just write that type out of the policy.
Exactly.
What are in these policies today? Like, what general coverage are you seeing that people are getting? What kind of premiums are, like, how much would you recommend an organization get? How do you assess your risk?
Yeah, I think that would depend on a lot of factors, Jason, right? Because it's not the one size fits all kind of an approach. The organization needs to look at its risk appetite. How much money does it have to pay for its own claims?
Yeah.
It has to assess its risk profile. I mean, if you're a technology company, if you're a healthcare company, you're probably more prone to lawsuits than if you're not. And are you a publicly traded company versus a privately traded company versus a nonprofit? Right? I think that's another factor to consider. What kind of controls do you have in place so that the directors and officers don't get into trouble? What kind of disclosures you're making? What kind of jurisdictions you're operating in? If you're operating in the United States and the rest of the world, if the federal government has a different DEI or a ESG kind of a policy,
Right.
while EU and other countries have different ESG and DEI policies, how do you navigate that tightrope to make sure you are in compliance with all the jurisdictions and the disclosure? So I think there's a lot of stuff that need to work with your agent and broker to make sure that you're structuring the right kind of policies. The market is soft. So basically, so at least in that context, deductibles and the retentions you could probably, play around with.
Yeah.
But the kind of tower you need, the kind of coverage you need, I think you need to work with your broker, make sure that you structure it properly so that you don't get into trouble.
And make sure that you're getting clauses in there that cover past the execution date.
Exactly.
Because for a lot of the stuff, 7 years or after the fact, people can still file.
Yeah, I think it differs from the policy to policy. I think there's really not much of standardization, but it could be 7 years. The retroactive date could be 1 year or 2 years before the policy starts. So all that needs to be considered, right? I mean, so that's the key to structuring a D&O policy.
Correct me if I'm wrong, but you teach finance, right, as well?
Yes, I do teach finances.
So how has your work in academia shaped the way you think about risk in a commercial context?
I think when students ask me very, very basic questions, it tickles your mind because, you probably assume that you know everything. So I think in that way, I think it's a refreshing thing to teach young people who are completely naive to the industry, but they are willing to learn, curious to learn. In fact, I was teaching during the COVID pandemic, and as past president put it, you don't let any crisis go to waste. That was a great moment for us to talk about, can insurance really cover a pandemic? What kind of product will you design in order to cover these kind of events? Does this need a public-private partnership? So there are a lot of things you can talk about in order to bring about ideas and innovation into the industry using these fresh minds who are not doing the typical insurance kind of thinking.
Yeah. So one thing I'm interested in asking you a follow-up to that is, do you see a disconnect between theory and practice when it comes to risk transfer? We talk a lot about risk transfer. Is the theory of risk transfer and the practicalness of how people do it, are they connected? Are they the same? How do you navigate the very real world that, what you might learn in school is different than what it's like to work in the field? What are your thoughts around that?
That's great. Actually, there is a lot of disconnect in terms of the theory and application. But at the same time, the theory is absolutely essential in order for you to understand why you need a risk transfer mechanism, how you structure a risk transfer mechanism, how do you not get overwhelmed by actuarial or financial models, right? Because you look at, I teach basic Monte Carlo simulation, and I tell my students, hey, you look at any catastrophe model or any other financial model, don't get overwhelmed. They are basically random number generators. They use a lot of other good engineering and other stuff in order to buttress the model and make sure that it's robust. Yeah. But the engine is essentially a kind of a simulator to make sure that you try to predict losses at different confidence level. Right. What's the stress to a company because of these kind of scenarios? So the theory is really important. And then I tell them, hey, I'm not going to teach you a D&O underwriting course or a cyber underwriting course. You get into a good firm, they're going to make sure that you understand how to underwrite a cyber risk, how to underwrite a D&O.
You look at, if you're going to say go work at a brokerage or a carrier, you look at the practical side should be supplied by industry. The people out of the school should come with a solid theory.
Exactly. They need to have an appreciation for risk transfer, insurance, reinsurance. They need to have a general idea of what insurance is all about and appreciate it. When they get to work, they are really getting taught at work about How do you underwrite a certain line of business? I mean, these are all very, very specialized niche areas, right?
Yes.
A D&O underwriter needs to know the law. They need to know what the risks are in a public company, private company, nonprofit company. There's a relationship aspect, right? So how do you work with the client to make sure that they get a good insurance deal? How do you work with the insurance company? There's a lot of relationship aspects that really cannot be taught.
What about things like reputational things? Like, should all of that be considered when you're thinking about when you're writing something like this? Like, does deep research have to be done on who are directors and does that impact policy? Or is it, since I'm not familiar on how that model is actually built behind the scenes, is that a factor? Is it if you have, say, officers who have been in trouble before, are you going to have to pay a higher premium? Or is it based on the company itself? Like,
Yeah. I'm not a D&O underwriter.
Yeah.
Not exactly sure what.
So each of that secret sauce is within it.
Exactly.
And that's sort of a little bit of the fear is like, it's not 100% transparent how people are pricing this and what the cost is actually going to be.
Right.
And other things there's a
Exactly.
lot of historical data to.
Yeah, and that's what you communicate to the client, right?
Yeah.
So you communicate to the client, hey, you're in a technology company. Alphabet just got sued because it let its developers access personal data of users.
Yeah.
We don't want these kind of issues to happen. That puts you in a high risk environment. And like you said, directors and officers, here's their past history. And so you look at management, you look at the execution of the risk profile of the company. All these factors need to be considered.
Let's play a game of risky or too risky. Yeah?
Yeah.
Okay. Skipping D&O coverage for a private company with outside investors. Risky or too risky?
Too risky.
Too risky. Right. Of course, this is what the thing is about. Relying solely on internal counsel to assess security litigation risk.
I would say risky, yeah. Depends on the quality of the in-house counsel. But the external counsel will bring a broad perspective, right?
So is it something like if you were talking to a CEO, you might be like, hey, you want to go on the outside of this every 5 years, get a total assessment, and then have your general counsel execute against those strategies? What's AAM's best recommendation on how to?
We don't recommend. We are not underwriters. We are not brokers. So I would have to take a pass on that. But I think in general, just common sense would indicate in-house counsel with good expertise. They know the company. They know where all the secret skeletons are.
Hopefully not many.
Oh, yeah.
Using last year's D&O limits as a safe benchmark.
Again, I'll have to pass on that. I would say it's risky because the limits have been
more so. I was wondering if you know how people are viewing this, because it is something when I try to talk to people about it, it's like, oh yeah, we have that. They're not clear on it. I feel like it's kind of like something people start picking up during that Me Too movement and things like that, and then not sure on how to actually factor that into your risk profiles.
That's actually, it's a good question because as you see the market getting softer, in general, the terms and conditions usually get softer along with that. Right? Yeah. So as the terms and conditions get softer, you're going to see lower limits. So if you are using last year's limits as a benchmark, you're probably fine because you were getting lower limits last year, right?
Yeah. Last question for you. What's a piece of advice you would give someone entering into the industry?
I would say it's a very close-knit industry. This is an industry where if you work hard and you have a good attitude, I think it can get you very far.
Yeah.
And most important piece of advice is don't burn bridges. It's a very small industry. People know each other and you never know who you're going to run into some juncture. So don't burn bridges, be friendly. Even if you're leaving a company, just make sure your relationships are robust and
we're all doing the same thing here.
Exactly.
Right?
Yeah.
Different executions of it, but we're all doing the same thing.
Exactly. Yeah. We're all in the business of helping the world, the economy to be more resilient, people to be more resilient. So let's treat it as a friendly ecosystem it is and keep it that way, right?
I really appreciate your time today. Thank you for joining me.
Thank you so much.
Thank you.
Risk Management Brick by Brick is brought to you by TrustLayer. Find out how TrustLayer manages risk so that the people can build the physical world around us. Head over to trustlayer.io and then make sure to subscribe to Risk Management Brick by Brick on Apple Podcasts, Spotify, or wherever you get your podcasts. On behalf of the TrustLayer team, thank you for listening.